Welcome, future market masters. Alex here, from Breakout Bars Studio. And if you're ready to truly understand the heartbeat of the financial markets, you are absolutely in the right place. Seriously, get ready to unlock some serious knowledge today, because what we're about to dive into is the absolute bedrock of all profitable trading. We're talking about market structure. Think about it. Every single price movement, every swing, every trend, every reversal, it all tells a story. And for us day traders, reading that story correctly is the difference between guessing and executing with confidence. You've heard people say, the trend is your friend, right? Well, today, we're not just going to make friends with the trend. We're going to understand its entire family tree, its habits, its secrets. This isn't just theory. This is practical, actionable insight that you can apply to any market, any time frame, starting right now. My goal today is simple. By the end of this video, you won't just know about market structure. You'll see it, feel it, and understand how to leverage it to make smarter, more consistent trading decisions. We're going to peel back the layers, covering everything from the foundational pillars of support and resistance to the advanced tactics of liquidity sweeps, and how to identify those crucial reversal points. We'll even talk about where the smart money likes to buy and sell using premium and discount ranges, and of course the powerhouses of supply and demand. Now, before we get started, a quick but important reminder, what you're about to learn here at Breakout Bars Studio is for educational and entertainment purposes only. This isn't financial advice. Trading involves risk, and it's essential to do your own research and manage your capital wisely. Alright, good. Let's get this knowledge party started. Alright, let's kick things off with the absolute fundamentals. What is market structure, really? When most people look at a chart, they see a bunch of green and red bars going up and down. And yes, at its core, that's price action. But market structure is about the organization of that price action. It's the framework, the skeleton upon which all other market movements are built. It's how price moves from one point to another, forming patterns, trends, and ultimately telling us where it's likely to go next. Think of it like a journey. Price doesn't just jump randomly. It travels, it pauses, it sometimes takes detours, but it always leaves footprints. Market structure is our map, helping us interpret those footprints. It answers questions like, is the market currently going up, down, or sideways? Where are the key battlegrounds between buyers and sellers? And perhaps most importantly, when is the momentum shifting? Now, I'm going to assume you've got a basic handle on candlesticks. You know your green or white bodies represent bullish movement, closing higher than they opened, and your red or black bodies mean bearish pressure, closing lower. You understand the wicks show the high and low points reached during that period? If you need a deeper dive into candlestick basics, we've got other videos covering that, so make sure to check those out. For today, just know that these little candles are our building blocks, our data points that collectively form market structure. And here's a crucial point that trips up a lot of new traders. Time frames. Market structure isn't static, it's fractal. What does that mean? It means the same patterns, the same principles, repeat themselves across all time frames. A major uptrend on a daily chart might look like a series of smaller uptrends, downtrends, and consolidations on a 15-minute chart. This is the beauty and the complexity of multi-time frame analysis, which we'll touch upon throughout this lesson. The market is like a Russian nesting doll, structure within structure within structure. Understanding this fractal nature is vital. Why? Because it helps us align our trades with the bigger picture. Imagine trying to surf. You wouldn't just look at the tiny ripples right around your board, right? You'd look at the big waves, the current, the horizon. It's the same in trading. We need to know what the big wave is doing, higher time frames. Before we try to catch a small wave, lower time frames for our entry, this gives us conviction and keeps us from trading against the dominant force. So, when we talk about market structure today, remember we're looking at patterns that repeat, whether it's on a 1-minute chart for scalpers or a weekly chart for swing traders. The principles remain the same. Our job is to identify those principles and use them to our advantage. Alright, with those foundations laid, let's get into the absolute core battlegrounds of the market. Support and resistance. This is where the rubber meets the road, where buyers and sellers truly face off. Get ready. Alright, my trading adventures. Let's talk about the absolute warriors of the market, the unsung heroes and formidable villains of price action, support and resistance. If market structure is our map, then support and resistance, or essence, as we call it, these are the ancient fortresses and strategic battlegrounds marked on that map. These are the places where the market has previously said, stop. Not so fast. Or, all right, this looks like a good spot to turn around. So, what are the... Simply put, support is a price level where buying interest is strong enough to prevent the price from falling further. Imagine a floor, a strong concrete slab. When price hits it, it often bounces back up. It's where the bulls, the buyers, historically step in and say, this price is cheap enough. We're buying. Conversely, resistance is a price level where selling interest is strong enough to prevent the price from rising further. This is our ceiling, our roof. When price hits it, it often struggles to break through and bounces back down. It's where the bears, the sellers, historically take over and declare, this price is too expensive. Time to sell. But why do these levels even exist? It's not magic, folks. It's market psychology and institutional memory. Think about it. A month ago, price bounced perfectly off $100. People who bought there made money. People who sold short there lost money. When price comes back to that same level, what do those people remember? The buyers who made money will think, hey, that was a good spot last time. I'll buy again. The sellers who lost money might think, I got stopped out last time, but I still believe it's going lower. I'll short here again. And the institutions, with their massive orders, they also remember these levels where significant trading activity occurred. It creates a self-fulfilling prophecy, a shared memory that guides future price action. Now, let's get practical. How do we draw these crucial levels? This is where many new traders get lost, drawing lines everywhere. We don't want to draw every minor wiggle. We want to identify the key battlegrounds, the significant turning points. Start by looking for the most obvious peaks and valleys on your chart. Points where price clearly reversed, direction with strength. These are your strong historical highs and lows. There are a few ways to draw them. First, horizontal lines. These are your classic SNR. Draw a line from the high of a previous swing high or the low of a previous swing low. But here's a pro tip. Price isn't always going to respect a single pixel-perfect line. Think of SNR more as zones or areas. Why? Because the market is made up of millions of participants, not one robot following a precise line. A zone accounts for some wiggle room. I often draw a small rectangle, encompassing both the wicks and the body of the candles around that turning point. This gives you a more realistic expectation of where price might react. Now, wicks versus bodies. Should you draw your line at the very tip of the wick or the close of the candle body? My preference, especially for tighter levels, is to use the wicks to define the extreme of the zone and the bodies to define the most respected part of that zone. When price pushes into a zone and reverses, often the candle bodies might respect a line, while the wicks briefly test beyond it. By thinking in zones, you cover both. The touch principle is another key. How many times does price have to hit a level for it to be significant? Generally, the more times a level has been tested and held, the stronger it becomes. Think of a wall. If a wall stops a ball once, it might be a fluke. If it stops it 5 times, you know it's a solid wall. 2 or more significant touches are usually good starting points for validating a strong SNR level. However, remember, the more it's tested, the weaker it can eventually become because orders at that level are slowly being consumed. It's like a battery slowly draining. And here's where SNR gets really fascinating. The role reversal, or flip levels. This is a powerful concept. Imagine that ceiling we talked about, a resistance level. Price struggles, then boom, it blasts right through it. What happens then? That old ceiling often becomes our new floor. The former resistance level now acts as support. And if a floor, a support level, breaks, it often becomes a new ceiling, a resistance level. This flip happens because the market participants who were trying to sell at resistance, once it breaks, realize they were wrong. They might then look to buy at that same level when price retests it. It's a powerful validation of a shift in market sentiment. Identifying these flip levels gives you incredible insight, showing where big money has committed to a new direction. This brings us to a really important distinction: breakouts versus fakeouts. A breakout is when price decisively moves beyond a significant SNR level, showing strong conviction. A fakeout, on the other hand, is when price briefly pushes past an SNR level, only to quickly reverse and move back within the previous range. Fakeouts are designed to trap impatient traders. We'll dive much deeper into this when we talk about liquidity sweeps. But for now, understand that not every breach of SNR is a true breakout. Patience and confirmation are your best friends here. So, to recap our S&R segment, they are psychological battlegrounds. Draw them as zones using significant swing highs and lows. Look for multiple touches to confirm strength. Master the concept of role reversal. Old resistance becomes new support. And always be aware of the difference between a true breakout and a tricky fake. Alright, with support and resistance under our belts, we now know where the market's boundaries are. But how do we know which way the market is actually heading? That brings us to our next critical piece of the puzzle. Trend identification. Thanks for watching, and don't forget to hit that subscribe button for the next lesson. Alright, trading champions. We've talked about the walls and floors are support and resistance. But now, let's talk about the direction we're traveling. Are we climbing a mountain? Are we descending into a valley? Or are we just kind of wandering around in a flat field? This is where trend identification comes into play. And it's absolutely fundamental. You've heard the saying, the trend is your friend. Well, today, we're not just saying hi to our friend, we're learning to walk hand in hand with it, because trading with the trend significantly increases your probability of success. So, what defines a trend? It's not just a bunch of green candles in a row. A true, sustained trend follows very specific rules, like a well-choreographed dance. Let's start with the most desirable dance of all. In an uptrend, the price is generally moving higher, but it's not a straight line. It moves in waves, like a staircase. It makes a high, pulls back to a low, then moves up to make an even higher high, and then pulls back to a higher low. This sequence is absolutely critical. Higher highs, followed by higher lows. Let's break it down. A higher high is when the market makes a new peak that is above the previous peak. It shows the buyers have enough strength to push the price beyond where they previously topped out. It's a clear sign of bullish power. Then you have the higher low. This is when, after making that higher high, the market pulls back, but it finds support and reverses above the previous low. This is crucial. It tells us that sellers have enough power to push the price down to the previous floor, meaning buyers are stepping in at increasingly higher prices. It signifies strength and continued demand. So, when you see price consistently making higher highs and higher lows, you are officially in an up. This is our mountain climbing phase. As day traders, when we identify our primary objective shifts, we are looking for buy opportunities. Ideally, when the price pulls back to form a higher low, because that's typically where the best risk to reward entries are, aligning perfectly with the dominant market direction. Now, what about the flip side? Our journey down the valley? The downtrend. Just like an uptrend, a downtrend isn't a straight plummet. It's a series of steps downwards. In a downtrend, the price consistently makes lower lows followed by lower highs. Let's define these. A lower low is when the market makes a new trough that is below the previous trough. It signals that sellers are successfully pushing the price to new, lower levels. A lower high is when, after making a lower low, the market retraces upwards, but it finds resistance and reverses below the previous high. This is key. It tells us that buyers want to have enough strength to push the price up to the previous ceiling, meaning sellers are stepping in at increasingly lower prices. This signifies continued bearish pressure. When you see the price consistently printing lower lows and lower highs, you are in a downtrend. This is our valley descending phase. In a downtrend, our focus as day traders pivots entirely. We are now primarily looking for sell or short opportunities, ideally when the price retraces to form a lower high. This allows us to join the dominant bearish momentum from a good vantage point. But what happens when the market isn't climbing a mountain or descending a valley? What if it's just well, wandering around in a field? This is what we call range-bound movement or consolidation. In this scenario, the price is essentially trapped between a clear support level and a clear resistance level, bouncing back and forth without making decisive higher highs, higher lows, lower lows, or lower highs. It's like a tug-of-war where neither the bulls nor the bears can gain a significant advantage. Consolidation periods are often accumulation or distribution phases by larger players, preparing for the next big move. For day traders, these ranges can offer opportunities to buy at support and sell at resistance. But more commonly, it's a time to wait patiently for a definitive breakout from the range. Trying to force a directional trade within a tight range can be frustrating and lead to getting chopped up. So sometimes, the best trade is simply no trade at all. Now, here's where it gets really exciting and critically important. Trend reversals. How do we know when our friend, the trend, might be leaving us or even turning into an enemy? The first major signal of a potential trend reversal comes when the established pattern of higher highs and higher lows, or lower lows and lower highs, is broken. For example, in a strong uptrend, if the price fails to make a higher high, or worse, breaks below the last significant higher low, that's our initial red flag. It tells us the bullish structure is compromised. Similarly, in a downtrend, if the price fails to make a lower low, or crucially, breaks above the last significant lower high, that's a strong indicator that the bearish momentum might be fading and a reversal could be underway. We'll delve much deeper into confirming these reversals later, but for now, just remember that the breakdown of these patterns is your earliest warning system. Before we move on, let's quickly touch on internal versus external structure. This goes back to the fractal nature of the markets. External structure is the larger, overarching trend. On a daily chart, you might see a strong uptrend with its higher highs and higher lows. This is your big picture wave. Internal structure refers to the smaller price movements within that larger trend. So, on a 15-minute chart, within that daily uptrend's pullback to form a higher low, you might see a smaller, temporary downtrend. With its own lower lows and lower highs, understanding both is vital. You want to align your trades with the external structure, but use the internal structure for refined entries. For instance, if the daily chart is in a strong uptrend, you'd be looking for buys. When the 15-minute chart makes a pullback, which is a temporary internal downtrend, you'd wait for that internal downtrend to show signs of reversing back into a smaller uptrend. Then you enter, perfectly aligning with the bigger picture. This multi-time frame thinking is incredibly powerful because it gives you both direction and precision. So, now we can identify the market's direction and understand its hierarchical movement. We know where the walls are from our support and resistance lesson, and we know whether we're moving up, down, or sideways by identifying our trend structure. But what about when the market tries to trick us to steal our hard-earned stops? That's where the smart money plays their games, and it's called liquidity sweeps. In our next video, get ready to unveil some institutional secrets. Thanks for watching, and don't forget to hit subscribe so you don't miss it. All right, my fellow market detectives, let's pull back the curtain on one of the market's most common and often frustrating tricks. You've probably experienced it. You set your stop loss perfectly below a support level. Price wicks down just enough to hit your stop, and then immediately reverses and shoots up in your intended direction. Or maybe you enter a breakout trade above resistance. Price pushes slightly higher, triggers your entry, then crashes down, leaving you holding the bag. Sound familiar? Welcome to the world of liquidity sweeps. This isn't random bad luck. It's often a calculated move by the big institutional players, the banks, hedge funds, and large funds to engineer price movements that benefit their massive orders. They need something we all provide, liquidity. So, what exactly is liquidity in this context? Simply put, it's the volume of buy and sell orders available at a given price. Imagine a vast ocean. For a massive whale, which is an institution, to take a huge gulp of water, they need a lot of smaller fish. Our orders, swimming around. Specifically, institutions are hungry for areas where there's a dense cluster of orders. Where do these clusters typically form? They form around obvious price levels. First, stop losses. These are placed below significant swing lows, which are sell stops, and above significant swing highs, which are buy stops. Retail traders are taught to place their stops there. Next, we have buy stops or sell stops for breakouts. Traders looking to enter a trade when price breaks a level will place buy stops above resistance or sell stops below support. And finally, there are pending limit orders from traders waiting to buy at a specific support or sell at a specific resistance. All these orders, especially the stop losses and breakout entries, create pools of readily available volume. This is the fuel that institutions need to fill their massive positions without moving the market too much against themselves. If they want to buy 100,000 shares, they can't just slam a market buy order, because it would rocket the price up against them. They need to accumulate their position stealthily. Now, let's understand the sweep concept. Imagine an institution wants to sell a huge amount of stock. If they just market sell everything, the price will crash, and they'll get terrible fills. What do they need? They need buyers. Where are the buyers? Often, they are above significant highs, which are buy stops from short sellers covering or breakout traders entering buys. They are also below significant lows, which are limit buys from people wanting to buy cheap. So, what do institutions do? They will often drive price just beyond a key level, like a previous high to sweep or collect all those buy stop orders. When those buy stops are triggered, it creates a surge of buying volume, pushing the price higher briefly. This momentary surge of buying is exactly what the institution needs to offload their massive selling position at a higher price. Once their orders are filled, they then let the price collapse, often reversing sharply in the opposite direction. They use your stop losses and breakout entries as their exit liquidity. These are your classic stop hunts or liquidity grabs. They're designed to take out weak hands, trick breakout traders, and provide optimal entry or exit points for the smart money. Once you understand them, you stop being the prey and start seeing the traps before they're sprung. So, where are the most common areas where these sweeps occur? First, below old lows and above old highs. This is the most classic setup. Traders place stops here, equal highs or equal lows. Where prices topped out or bottomed out at roughly the same level multiple times are particularly juicy targets, as they signal even larger clusters of liquidity. They also happen underneath obvious support and resistance levels. Just like we discussed, below support and above resistance are prime areas for stops. And finally, you have trendline liquidity. Sometimes, a clear trend line will form, and traders will place stops or entries just beyond it. Institutions will often push the price just past that trend line, triggering those orders, and then reverse. How do we identify these sweeps on our charts? Look for these telltale signs. The most common visual cue is wicks extending beyond levels. Price wicks briefly through a previous high or low or a support and resistance zone, but the candle body closes back within the original range. This shows rejection. Another sign is quick, aggressive reversals. After the sweep, the price doesn't linger. It snaps back quickly, often with strong opposing candles. You might also see high volume on the sweep candle. While not always present, sometimes the sweep candle can show increased volume as stops are triggered, but then the next candle shows even higher volume as the reversal takes hold. Finally, look for engulfing candles or pin bars immediately after the sweep. These are powerful reversal candlestick patterns that frequently form right after a liquidity grab, signaling the smart money's true intention. So, how do we trade with this knowledge? We don't want to be the liquidity. We want to understand it and potentially trade with the smart money. The first key is patience. Instead of blindly entering a breakout, wait for confirmation. See if the candle closes decisively above or below the level, or if it just wicks through and immediately reverses. Next, look for the false breakout pattern. If price sweeps a high, then immediately reverses with strong bearish candles. That often signals a good short opportunity. You can then place your stop above the swept high. Also, learn to anticipate. When price approaches a known liquidity area, be extra cautious. Expect a potential sweep before a true move in either direction. This helps you avoid prematurely entering a trade or getting stopped out unnecessarily. And most importantly, look for confluence. Sweeps are incredibly powerful when combined with other market structure concepts. For example, if price sweeps an old high and it's at a major resistance level from a higher time frame, and it's also in a premium range, which we'll cover soon, that's a very high probability reversal setup. Understanding liquidity sweeps is like gaining X-ray vision into the market. It allows you to see the hidden hand of the institutions and avoid falling into their traps. It shifts your perspective from reactive to proactive, turning potential stop-loss triggers into potential profit opportunities. No more getting faked out and frustrated. We're becoming smarter traders. Now that we know how to spot these clever traps, let's talk about how to truly confirm when the market is making a definitive shift in direction, moving beyond just a sweep. In our next video, we're going to dive into reversal points, those crucial moments when the trend truly changes its mind. Thanks for watching, and don't forget to like and subscribe so you don't miss it. All right, market navigators! We've learned to identify the market's boundaries with support and resistance. We've mastered reading the market's direction through higher highs and higher lows, and we've even uncovered the institutional trickery of liquidity sweeps. But now, it is time to put on our detective hats and learn how to definitively confirm when the market is truly changing its mind, when a trend is not just pulling back, but making a full-fledged reversal. Think of a trend like a beautiful, well-oiled machine moving in one direction. It makes its swings, it pulls back, but it always maintains its core structure. A reversal, however, is when that machine fundamentally breaks down, changes gears, and starts moving in the opposite direction. It's not just a temporary pause, it's a strategic shift. So, how do we confirm these reversals? We don't want to jump the gun based on one candle. We need evidence, and the strongest piece of evidence, the gold standard for confirming a structural shift, comes from what we call a break of market structure, or BOSH. You might also hear it called a change of character, or see. Let's break down the break of market structure. Remember, our uptrend is characterized by those consistent higher highs and higher lows. The integrity of that uptrend depends on price continuing to make new higher highs and, crucially, holding above its previous significant higher lows during pullbacks. These higher lows are the foundations of the up. If one of these foundations collapses, the entire structure is compromised. So, in an uptrend, a break of market structure occurs when price decisively closes below the last significant higher low. This is our primary signal that the bullish momentum has shifted, and sellers are now in control. It's the market telling us, hey, that upward staircase, it just broke a step, and we might be heading down now. Why is the close so important? Because of what we learned about liquidity sweeps and FI. A wick below a higher low could just be a liquidity grab before continuing up, but a full candle body closing decisively below that higher low, that's commitment. That's the market saying, we're serious about this new direction. This is when the institutions have absorbed enough opposing orders and are pushing for a genuine change. Conversely, for a downtrend, a break of market structure occurs when price decisively closes above the last significant lower high. Remember, in a downtrend, price is making lower lows and then pulling back to lower highs. These lower highs are the ceilings that keep the bearish pressure intact. If price breaks above one of these ceilings, it signals that buyers are now strong enough to challenge the seller's dominance. The downward staircase has lost a step, and we might be starting to climb again. These boss events are not just random movements. They are the market's way of explicitly signaling a change in the dominant force, offering fantastic opportunities for traders who know how to spot them. Beyond the actual price action, volume clues can add another layer of confirmation to our reversal points. When a significant break of market structure occurs, especially if it's accompanied by a noticeable increase in trading volume, that adds more conviction to the move. High volume on the breaking candle suggests strong institutional participation and genuine interest in pushing price in the new direction. It is like hearing a loud cheer when a team scores. It confirms the importance of the event. Now, you might also see candlestick reversal patterns forming around these boss points. Things like bullish or bearish engulfing candles, pin bars, or dojis. While these patterns are powerful, they are best used as components of a reversal signal, not as standalone indicators. A pin bar at a crucial support and resistance level after a liquidity sweep, which then leads to a boss on a lower time frame. Now that's a powerful confluence. And that word, confluence, is exactly what we're aiming for. True high-probability reversal points are rarely confirmed by just one factor. They're confirmed by multiple confluences working together. When you see a liquidity sweep of a major high followed by a strong bearish engulfing candle and then a decisive break of market structure by closing below the last significant higher low, that's a symphony of signals telling you the trend is likely turned. It's like all the instruments in an orchestra playing in perfect harmony. Identifying these reversal points allows you to exit losing trades, take profits from existing trades, and enter new ones in the direction of the nascent new trend. So, with the power to spot true reversals, we're becoming incredibly skilled market interpreters. But what about understanding the value of price? When is something genuinely cheap to buy or genuinely expensive to sell? That brings us to a fundamental concept of smart money trading: the premium and discount range. Let's uncover where the true value lies. All right, market architects. We've built a solid foundation. We're spotting reversals. But now, let's talk about value. Because in trading, just like in any business, you want to buy low and sell high, right? Sounds simple, but how do we objectively define low and high in a dynamic market? That's where the premium and discount range comes into play. Think of any item you want to buy. You don't want to buy it when it's overpriced, do you? You want a discount? The market works the exact same way. Institutions, with their massive capital, are not buying at the top of a rally. They're looking for opportunities to buy at a discount. And they're not selling at the bottom of a crash. They're looking to sell at a premium. This concept is a cornerstone of how smart money operates, and we can leverage it. The premium and discount range helps us identify areas where price is considered cheap or expensive within a specific price swing or range. We use a simple but powerful tool to define these zones: the Fibonacci retracement tool. Here's how it works. First, we have equilibrium, which is the 50% mark, or the exact midpoint of any swing. This represents the fair value of that price move. It's the balance point. Anything above the 50% mark is considered the premium range. This is where price is relatively expensive. As traders looking to buy, we generally avoid buying in premium. If we're selling or shorting, this is an ideal zone to look for entries. Anything below the 50% mark is the discount range. This is where price is relatively cheap. As buyers, this is our preferred zone to look for entries. So, how do we apply this in a trending market? In an uptrend, when price makes a strong impulse up and then begins to pull back, we want to see that pullback enter the discount range of that impulse leg. This tells us that institutional buyers are likely to step in here buying the dip at a good value. In a downtrend, when price makes a strong impulse down and then begins to retrace upwards, we want to see that retracement enter the premium range of that impulse leg. This signals that institutional sellers are likely to step in and sell at a good value. Now, how to draw the Fibonacci tool correctly is essential. For a bullish move, where you're looking for buys, you draw from the swing low to the swing high of the impulse leg you are analyzing. The 50% level will then divide the move into discount, which is below 50%, and premium, which is above it. These ideal entry zones in the discount for buys and premium for sells dramatically improve your risk-to-reward ratio. Why try to buy at the very top, where price is expensive? Why try to sell at the very bottom, where price is cheap? The smart money doesn't do that, and neither should we. Here's where it gets even more powerful. Connecting premium and discount to other market structure concepts. This is where confluence really shines. Imagine an up price pulls back into the discount range, and it hits a previously flipped resistance turn support level. That's a double confirmation of a strong area for buyers. Or if price makes a strong bearish move, then retraces into the premium range and it also forms a new lower high there, possibly with a liquidity sweep, then that's an incredibly high probability zone to look for a short entry. The premium and discount range provides an objective filter for our trades. It helps us avoid chasing price and instead encourages patience, waiting for price to come to us in a value area. By incorporating this into your analysis, you're not just trading with the trend, you're trading with the value that institutions are looking for. We've covered the boundaries, the direction, the traps, the turns, and now the value zones. But there's one more layer to this institutional puzzle, arguably the most potent areas of all. These are the hidden zones where true imbalance occurs, where the largest orders are executed. I'm talking about supply and demand. Alright, trading elite. We've navigated the market's landscape, dodged its traps, and identified its value zones. Now, we arrive at what I consider the absolute core engine of price movement, supply and demand zones. If market structure is the map, and support and resistance are the fortresses, then supply and demand zones are the hidden command centers where the biggest institutional battles are initiated, causing massive shifts in power. So, what exactly are supply and demand zones? These aren't just your typical support and resistance. These are very specific price areas where there was a massive, imbalanced transfer of orders that led to a sharp, aggressive move in price. Think of it like this. A huge institution needed to buy or sell an enormous quantity, and to do so, they had to step in with so much force that they completely overwhelmed the opposing side, causing price to explode away from that point. These zones represent unfulfilled orders, essentially the footprints of institutional activity. When price revisits these zones, those remaining institutional orders are still sitting there, waiting to be filled, often causing price to react strongly again. Let's define them. A demand zone is a price area where a massive amount of buying pressure entered the market, causing price to rally sharply upwards. It's an area where institutions were aggressively accumulating or buying. When price pulls back to a fresh demand zone, the expectation is that those same institutions will step in again, pushing price higher. Think of it as a launch pad for rockets. Once launched, the next time it comes back, it's ready to launch again. Conversely, a supply zone is a price area where a massive amount of selling pressure entered the market, causing price to fall sharply downwards. This is where institutions were aggressively distributing or selling. When price retraces back to a fresh supply zone, the expectation is that those unfulfilled sell orders will trigger again, pushing price lower. Think of it as a massive brick wall. Once price hits it, it struggles to get through. The origins of these zones are crucial. They're characterized by aggressive moves, a strong, impulsive candle or a series of strong candles moving swiftly away from the zone. You'll see an imbalance, a clear lack of opposing orders in the direction of the move. Price doesn't linger. It gets pushed away quickly, and often, just before the aggressive move, you'll see a small consolidation or a few indecision candles. These are the base candles where the institutions were quietly accumulating their positions before the big push. Now, how do we draw these zones? This is where art meets science, but with clear rules. For a demand zone, when you're looking for buys, you first identify that strong move up. Then, look for the base candles just before that move. You typically draw the zone from the lowest wick of the base candles up to the high of the highest body or wick of those base candles. This captures the entire area of accumulation. For a supply zone, when you're looking for sells, you identify the strong move down. Look for the base candles just before that move. You typically draw the zone from the high of the highest wick of the base candles down to the low of the lowest body or wick of the base candles. This captures the entire area of distribution. A key concept here is fresh versus tested zones. Fresh zones are the most powerful. These are zones that price is created but is not yet returned to retest. They have a higher probability of holding because the majority of those institutional orders are still sitting there, waiting to be filled. Tested zones are zones that price has visited and bounced off of previously. While they can still work, their strength diminishes with each test as those pending orders get consumed. Think of a battery. A fresh one is full of charge. A tested one has used some of its power. So what happens when a zone fails? A zone breakdown occurs when price moves through a supply or demand zone with conviction, often closing decisively beyond it. This tells us that the imbalance of orders at that level has been completely overwhelmed or consumed, and the market is moving on. A broken demand zone often becomes a new supply zone, and vice versa, confirming a shift in market control. This is that role reversal we've talked about before. And just like with every other concept, the true power of supply and demand comes with confluence. Imagine a demand zone forms right at a significant support level after a liquidity sweep of previous lows, within a discount range of the overall move, and then shows a break of market structure on a lower time frame. Now that's a setup. That's a high probability trade opportunity screaming at you. These zones act as magnets for price, and when they align with other strong market structure signals, they become almost irresistible. Understanding supply and demand allows you to pinpoint the origins of significant moves. It teaches you to look for the imbalances that drive price rather than just reacting to where price is currently. It's like seeing the chess game several moves ahead, not just reacting to the last piece moved. This is how the smart money trades. And now, it's how you can trade. My friends, we've covered some serious ground today. We started with the absolute basics and climbed all the way to the institutional battlegrounds, from support and resistance to higher highs and lower lows, liquidity sweeps, reversal points, premium and discount ranges, and now the powerful supply and demand zones. Individually, each of these concepts is powerful, but the true magic, the real edge in day trading, comes from their confluence. It's like having multiple witnesses all confirming the same story. When you see price behaving in a way that aligns with 3, 4, or even 5 of these market structure principles on your chart, your trade probability skyrockets. You're no longer guessing. You're trading with conviction, backed by the market's own story. This also ties back to our earlier discussion about multi-time frame analysis. Remember the Russian nesting dolls? We use higher time frames like the 4-hour or daily to establish our overall bias and identify major support and resistance, supply and demand zones, and the dominant trend. Then, we drill down to lower time frames, like the 15-minute or 5-minute, to find our specific entries, looking for liquidity sweeps, internal breaks of structure, and confirmations within our premium or discount zones. This top-down approach gives you both macro vision and micro precision. But here's the absolute truth, the non-negotiable step. Practice, practice, practice. Watching this video is a fantastic start, but becoming proficient means putting in the screen time. Go back through your charts, pick your favorite stocks, forex pairs, crypto, and start identifying these concepts. Draw your support and resistance, mark the higher highs and higher lows, spot those liquidity sweeps, find those supply and demand zones, backtest them. See how price reacted historically? This is how the theory becomes instinct. Wow, what a journey. If you've made it this far, give yourself a massive pat on the back. You've just equipped yourself with the foundational knowledge of market structure that, frankly, many traders spend years trying to piece together. This isn't just theory. This is the language of the smart money. And now, you speak it. Remember, every candle counts. Every swing, every pullback, every consolidation, it all tells a story. And by understanding market structure, you're not just reading the words. You're understanding the plot. So if you're serious about growing as a trader, if you're ready to make smarter, more consistent decisions based on what the market is actually telling you, then make sure you like this video to show your support and that you're ready for more. Subscribe to the Breakout Bars Studio channel so you don't miss any of our deep dives. And most importantly, hit that notification bell so you're alerted the moment we drop a new video, ensuring you never miss a breakout opportunity or a critical market insight. Welcome to the community, where we break down the markets together and build truly successful traders. This is Breakout Bar Studio, where every candle counts, and your success is our mission. And remember, folks, the content on this channel is for educational and entertainment purposes only and should not be considered financial advice. Trade smart, manage your risk, and keep learning.